As of 12:11 p.m. Eastern Time on October 2nd, 2025, Tilray Brands Inc., trading under the ticker TLRY, is priced at $1.63, reflecting a minor intraday dip of about 1.2%. Now, a slight pullback like that is business as usual on Wall Street, but what's far more interesting is the brutal volatility that figure masks. Just a few days ago, this stock rocketed up over 60% in a single session, a surge triggered by nothing more than a social media video from a prominent political figure discussing the benefits of CBD for seniors. That one event ignited a firestorm of speculative trading, creating a classic short squeeze and reminding everyone just how tethered Tilray's fate is to the whims of political sentiment. The expectation is that any positive regulatory news, no matter how flimsy, will send this stock to the moon. The reality, however, is a far more complex picture of a company navigating deep operational challenges, intense competition, and a market that is still fighting for mainstream acceptance and a clear path to consistent profitability. While the political winds can certainly fill its sails for a day or two, the underlying currents of its business fundamentals will ultimately determine its long-term destination. Many investors, particularly those who frequent platforms like Robinhood or SoFi, see Tilray as the quintessential cannabis play, a high-risk, high-reward bet on the future of federal legalization in the United States. The narrative is simple. Once the U.S. market opens up, a company with Tilray's scale and international footprint will be perfectly positioned to dominate. They see the recent acquisition of Hexo and the diversification into craft beer and spirits as smart, strategic moves to build a consumer brands powerhouse that's ready to flip the switch on cannabis products nationwide the moment it becomes permissible. This belief is what fuels the explosive, headline-grabbing rallies. But let's challenge that a bit. The reality is that this diversification, born out of necessity, also complicates the story. Tilray is no longer a pure-play cannabis company. It's a hybrid, juggling the low margins of the craft beverage industry with the regulatory headaches and pricing pressures of the Canadian cannabis market. The synergies between a brand like Sweetwater Brewing and a medical cannabis division are not as straightforward as one might think, and the company is burning through cash as it attempts to integrate these disparate businesses. The expectation of a seamless transition into the U.S. cannabis market overlooks the fierce competition that already exists on a state-by-state basis, from multi-state operators who have established brands, cultivation facilities, and retail dispensaries. Tilray won't just walk into an open field, it will be entering a well-established battleground. Looking at the recent stock movement, the volatility is impossible to ignore. After the massive surge late last month, we're seeing a period of consolidation and profit-taking. Trading volume has been immense, far exceeding the daily average, indicating that both institutional and retail traders are heavily involved. We saw the stock touch a high of $1.88 during the peak of the recent excitement, before pulling back to its current level. This kind of price action is a trader's paradise, but can be a long-term investor's nightmare. It's being driven by sentiment, not by a material change in the company's financial performance. Institutional ownership in Tilray sits at a relatively low 12%, which tells us that many of the large conservative funds you'd find in a Fidelity Wealth Management portfolio are still on the sidelines, waiting for more regulatory clarity and a clearer path to profitability. While there have been some interesting moves, with certain ETFs specializing in the cannabis sector increasing their positions, the overall institutional sentiment remains cautious. This is a stock largely in the hands of retail investors and more speculative funds, which contribute significantly to its wild price swings. For anyone doing self-investing through platforms like Interactive Brokers or even Schwab Intelligent Portfolios, understanding this dynamic is critical. The macroeconomic environment isn't helping either. Persistently high interest rates make it more expensive for companies like Tilray, which are not yet consistently profitable, to raise capital. Furthermore, in an inflationary environment, consumers may cut back on discretionary spending, which could impact sales in both the recreational and craft beverage segments. The strength of the U.S. dollar also presents a headwind for Tilray's international cannabis sales, particularly in Europe, where it has a significant presence. So what does Tilray actually do? At its core, it's a global cannabis and consumer packaged goods company. It operates in several distinct segments: cannabis for medical and recreational use, wellness products, and alcoholic beverages. The company has a significant footprint in Canada, which was one of the first major economies to legalize recreational cannabis. It also has a strong medical cannabis business in Europe, particularly in Germany, and is positioning itself for eventual entry into the U.S. market. The acquisition of its former rival, Afria, a few years ago, created one of the largest cannabis companies in the world by revenue. More recently, it has been on a buying spree in the beverage alcohol space, acquiring brands like Montauk Brewing Company, Alpine Beer Company, and Green Flash Brewing Company, in addition to its flagship Sweetwater brand. The stated strategy is to build a portfolio of lifestyle brands that can leverage a common distribution network and marketing infrastructure. The idea is to have these brands and their distribution channels ready to pivot to cannabis-infused products in the U.S. as soon as federal law allows. However, past performance shows a company struggling to translate its scale to profits. A look at their financial statements reveals a history of significant net losses and a challenging path to positive cash flow. While management has been focused on cost-cutting initiatives and achieving operational efficiencies, the intense price competition in the Canadian cannabis market and the costs associated with integrating its numerous acquisitions have continued to weigh on its bottom line. It's a classic case of a company with a grand vision that is proving incredibly difficult and expensive to execute. Thinking about the future, the outlook for Tilray is a tale of two very different potential paths. On the one hand, there is the optimistic scenario that the market is periodically pricing in. In this version of the future, the U.S. federal government reschedules cannabis, opening the floodgates to a multi-billion-dollar market. Tilray, with its established brands, production capacity, and distribution partnerships, would be a major beneficiary. Its beverage brands could quickly launch THC-infused versions, and it could begin to leverage its international medical cannabis expertise in the U.S. market. Further positive developments in Europe, such as the expansion of medical cannabis programs or moves towards recreational legalization in key countries like Germany, would provide another significant growth catalyst. In this scenario, the company's focus on building a diversified consumer brands portfolio would pay off handsomely, and its stock price could see a substantial re-rating. Comment below what you think the odds are of U.S. federal legalization happening in the next 2 years. On the other hand, there is a more sobering reality to consider. The path to U.S. legalization could be much slower and more complex than many anticipate. Even if cannabis is rescheduled, it may still be subject to heavy regulation and taxation, which could limit profitability. State-level regulations will continue to create a fragmented and competitive market. In this scenario, Tilray could find itself struggling to gain a significant foothold against entrenched U.S. competitors. Meanwhile, the challenges in its existing markets are not going away. The Canadian market remains oversaturated, with relentless pressure on prices and margins. The beverage alcohol industry is mature and highly competitive, and it will be difficult for Tilray to gain significant market share from established giants. If the company continues to burn cash without a clear line of sight to sustain profitability, it could face the need to raise additional capital, which could dilute existing shareholders. The risk for investors is that they are paying for the blue-sky potential of U.S. legalization, while the core business continues to face significant headwinds. An investment in a Fidelity ETF or a well-diversified individual brokerage account is a world away from the kind of risk inherent in a stock like Tilray. In conclusion, Tilray Brands perfectly embodies the tension between a compelling market narrative and a challenging operational reality. The expectation, fueled by periodic bursts of political optimism, is that of a coiled spring, ready to unleash its potential across the vast, untapped U.S. cannabis market. This is the story that drives the massive, sentiment-fueled rallies and keeps traders glued to their Robinhood or SoFi Invest apps. The reality, however, is a company bogged down by the difficult work of integrating a diverse and perhaps mismatched portfolio of assets in highly competitive and low-margin industries. It's a company fighting for profitability in a challenging Canadian market, while placing a massive bet on a regulatory outcome that is entirely out of its control. The recent 60% surge, followed by a quick pullback, is not an anomaly. It is the essence of what this stock is right now. It is a barometer of hope and speculation, rising and falling with every political rumor and tweet. While the long-term vision is undeniably ambitious, investors must weigh that potential against the very real and present challenges of cash burn, intense competition, and regulatory uncertainty. The true test for Tilray will not be whether it can ride the next wave of legalization hype, but whether it can build a fundamentally sound and profitable business that can thrive regardless of the political climate. That is the reality that will ultimately determine its fate long after the noise of the current trading frenzy has faded.